Imagine this. You finally saved up enough money to invest. You've been putting it off for months, maybe years. But today is the day. You open your brokerage app, you transfer your funds, and you pull the trigger. And then, but the market drops. You try again 6 months later, same thing, you invest, market drops. You try again, same thing, market drops. What if I told you that this person, the unluckiest investor on earth, someone who bought at the absolute peak every single time for 20 years? What if they actually ended up making money? Good money? Stick with me, because what you're about to find out will completely change how you think about investing. Let me paint a picture. Think about someone who always shows up late to the party, every time. The party's already at full swing, the food is almost gone, the best seats are taken, and that's when they walk in. Most people would say, that person has terrible timing, and on the surface, sure, but here's what nobody talks about. That person still got to enjoy the party. They still ate, they still danced. And when the party was over, they went home just like everyone else. Now, imagine the person who spent all night waiting outside the door, trying to find the perfect moment to walk in. They analyzed the music, they checked the crowd levels, they waited and waited and waited, they never went in. Who had a better night? That's exactly how investing works. And today we're going to break down why waiting for the right time might be the most expensive mistake you'll ever make. Welcome to Resurgam Ratio, where we explain investing concepts in a simple way. And before we dive in, this is not financial advice. Everything in this video is for educational purposes only. Always do your own research. Okay, let's get into it. Part 1. Who is this unlucky investor exactly? Let me introduce you to someone. Her name is Wendy. Wendy is not a professional investor. She doesn't watch Bloomberg every morning. She doesn't have a finance degree, but she's disciplined. Every single year, without fail, she sets aside $2,000 to invest in the S&P 500. Here's the catch. Wendy has terrible timing. We're talking cosmically, historically terrible timing. Every single year, she happens to invest on the exact day the market hits its annual peak, the absolute top, the worst possible day to buy, and she does this for 20 years straight. Now, if you're imagining a financial disaster, I completely understand. That's the logical assumption. But here's what actually happened. According to a study by Charles Schwab that analyzed market data over multiple decades, Wendy, our unlucky peak-buying investor, still came out with significant gains. After 20 years of buying at the worst possible time, her portfolio grew substantially. Not as much as someone with perfect timing, sure. But she made money, real money. Let that sink in for a second. The person with the worst possible timing, who invested at the market's highest point every single year for 2 decades, still won. So why does this happen? That's what we're going to unpack right now. Part 2. Why market peaks are less scary than you think. Here's the mental model most people have when they think about buying at a peak. If I buy when the market is high and it crashes, I lose everything. And look, on a short-term basis, that fear makes sense. If you bought in January 2022, the market dropped roughly 20% by the end of that year. That's painful to look at. But here's the thing. The stock market doesn't just go up in a straight line, and it doesn't just go down in a straight line either. Historically, the general direction over long periods has been up. Think of it like this. Think of it like a hiking trail up a mountain. The path isn't smooth. There are rocks, steep drops, muddy patches, and parts where you genuinely wonder if you're going backwards. But the destination, the peak of the mountain, is higher than where you started. As long as you stay on the trail long enough, you get there. Buying at an all-time high feels terrifying because your brain is focused on the next downhill step. But the market doesn't care about your anxiety. It has its own schedule, and that schedule historically trends upward. Here's a concrete number that might reframe this for you. Research from Hartford Funds found that the S&P 500 has reached new all-time highs, roughly 30% of all trading days since 1950. That means nearly 1 in 3 trading days was technically an all-time high. If you refused to invest on all-time high days, you would have sat out almost a third of all market history. 30% of trading days are all-time highs. Let that land. Bottom line, if you only invest when the market isn't at a high, you'll spend most of your time waiting instead of compounding. Part 3. The real enemy. It's not timing, it's time. Let's talk about the actual villain in this story. And it's not the stock market. It's not all-time highs. It's not even bad luck. It's inaction. Meet Alex. Alex has been wanting to invest for 3 years. He's done the research. He knows the basics. He has $5,000 sitting in a savings account, earning 1.5% interest. But every time he's about to pull the trigger, something comes up. The market looks too high. There's an election coming. Interest rates are moving. The news is scary. 3 years later, Alex still hasn't invested. Now meet Jordan. Jordan invested that same $5,000 3 years ago, right before a 15% market correction. Brutal timing, and then Jordan did nothing, just held. Fast forward to today. Despite that initial drop, Jordan's investment has recovered and grown. Meanwhile, Alex's savings account has barely kept up with inflation. In real terms, adjusted for the cost of living, Alex actually has less purchasing power than when he started. Alex didn't lose money because the market crashed. Alex lost money because he waited. Here's the research that backs this up. A study from Archbridge Family Office found that an investor who missed just the 10 best trading days in the market over a 20-year period had returns that were cut by more than half compared to someone who stayed fully invested. Just 10 days, out of roughly 5,000 trading days. The market's best days often follow its worst days. If you're sitting on the sidelines waiting for things to calm down, you're almost certainly going to miss the recovery. So the enemy isn't buying at the top. The enemy is not buying at all. Bottom line, time in the market beats timing the market every single time.
Part 4. But what about dollar cost averaging? Okay, so now you might be thinking, all right, I get it. I should just invest. But how? Should I put it all in at once or spread it out? Great question. Let's talk about dollar cost averaging, or DCA. DCA is a strategy where instead of investing a lump sum all at once, you invest a fixed amount on a regular schedule, say $200 every month, regardless of what the market is doing. Up or down, you invest. Rain or shine, all-time high or 10% correction. The beauty of DCA is what it does to your psychology. Instead of agonizing over, is this the right moment, you just invest. Automatically, on a schedule. No decisions, no stress, no anxiety. And here's the mathematical bonus. Because you're buying at different price points over time, you naturally buy more shares when prices are low and fewer shares when prices are high. Over time, this can lower your average cost per share compared to a lump sum purchase. Think of it like buying groceries every week instead of stocking up once a year. Some weeks oranges are $1, some weeks they're $2. But over time, your average price per orange is somewhere in the middle, and you never ran out of oranges because you panicked and didn't buy when the price seemed high. Now, does DCA guarantee better returns than lump sum investing? Not always. Studies, including research from Vanguard, have shown that lump sum investing actually outperforms DCA about 2/3 of the time, simply because more money is in the market for longer. But here's the catch. Lump sum investing requires two things most people don't have: a large sum of money available all at once, and the emotional steel to watch that lump sum potentially drop 20% right after you invest. For most everyday investors, DCA is the strategy they can actually stick with, and a strategy you can stick with will always beat a theoretically optimal strategy you abandon in a panic. Bottom line, DCA isn't the best strategy mathematically, but it's often the best strategy psychologically. And in investing, your psychology is everything.
But here's the catch, and this one might genuinely surprise you. All-time highs aren't just not bad times to invest. They're actually associated with above-average future returns. I know, that sounds backwards. Your gut says, if the market is at its highest point ever, it must be about to fall. But the data says something completely different. Historically, investing at an all-time high has produced higher average returns over the following 12 months compared to investing on a random day. Why? Because all-time highs tend to occur during periods of economic strength, strong earnings, low unemployment, growing consumer confidence. These same conditions that push the market to highs also tend to sustain momentum. It's counterintuitive, but the numbers don't lie. The market being at an all-time high isn't a warning sign. It's statistically a green flag. And yet, every time the market hits a new record, financial headlines scream about overvalued markets and bubble territory. Retail investors pull money out. They wait for a correction, and then they watch the market climb another 15%. This is what professionals call the wall of worry. The market literally climbs higher on the back of all the people who are too scared to get in. Don't be on the outside looking in. So, let's bring it all together. Wendy, our cosmically unlucky investor who bought at every single market peak for 20 years, still made money because time in the market is more powerful than any timing strategy ever invented. The real risk isn't buying at the top. The real risk is letting fear keep you on the sidelines while the market compounds without you. Stay consistent. Think in decades, not days. And remember, this is not financial advice. Do your own research, and if you're unsure, talk to a qualified financial advisor. If you found this video helpful, please hit that like button. It genuinely helps this channel reach more people who need to hear this. And if you're new here, subscribe so you don't miss what's coming next. You're not going to want to miss it. Thanks for watching, and see you very soon.